All right, guys. Dusted up my mic. Time to do a podcast. Some time has passed by, but sometimes that's great. You get to take a step back. I've realized that doing podcasts daily creates a lot of noise. Look, my charting framework is mostly monthly chart-based breakouts for the ultimate confirmation of the higher trend, and then most of the action to tune in the entry. I go down to the weekly at la Stan Weinstein, and that's why I came to the conclusion. Let's say you're doing monthly chart breakouts or breakdowns, then if you'd be checking the chart every day, every single day, you're checking the price ticker, eventually you might talk yourself out of a trade. Oh God, something's happening. Then you're too close to Twitter, too close to the news. So you have to adjust your frequency, the way you consult. You have to manage all that emotions of the time frame. So if you're on Twitter every 5 minutes, and you're trying to deal long-term positions through all this looks easy, but this is very, very, very hard to hold right here with all the daily noises. I guess back then, Stan had it easier. These guys plotting their charts, getting data once per week. Oh, they do a new chart. Am I still, my price action still above my 30-week moving average? Yes. Okay, move on to the next one. And they wouldn't get dazzled and razzled by daily news, daily information. So it's good to practice, adjust your frequency of input of information with your type of trading, position trader or swing trader or daily trader. Maybe he wants to check news every single second. But I decided to do a podcast because gold has a whole bunch of synergies going on right now. We just closed the monthly candle for gold spot in USD. I'll show that this was kind of predictable. Not that I can tell the future, but there was a lot of clues that this was going to happen for gold. Everybody's looking at gold in US dollars, but I had a lot of clues by looking at gold in other currencies that it was just a question of time before gold would break out against the US dollar. So it's kind of a little fortune crystal ball I had there. So right here, we have the shorter term pattern right here we broke out of 1, 2, 3, 4, 5 months base, 12-month average angling upwards. That's all great. But after that, we had some more resistance right here. A few years back, close above that. And after that, we had some more meaningful, or just about, 1350. I can stretch that one out here. Oh, Patrick, stretch that out. And that's everybody's been looking at 1350. But there's some right here. And then when I'll get to the GLD, which has a different, has a pretty strong correlation to xauusd, we didn't quite close above this previous resistance right there that dates all the way back to 2013. But again, the more meaningful resistance or support is always the ones closer to the breakout line. The further you are away, the less meaningful it is. So I don't know how much of an impact this one's going to have there. I still notice that it stopped there. But the fact that we close above that is another check mark that we need to sink back below August 2013, 95. It closed right here. We stayed above for the month. That's a very good sign right here. So what's going to happen next? There's kind of a vacuum right here, all the way to what I call a wall. Previous support and resistance at 1550 or a little higher. And after that, once we go through that, hopefully, look, this is a price to pay. When you go up and you start and you get like tweezer tops here, exponential, not exponential growth, but tweezer tops getting far away from the 12-month average, and then you have a consolidation pattern. If you can't survive that, then you go back down stage 4. And this time, this is the health process. The longer this process is, shaking out the weak hands, and for strong hands are the ones that aren't buying on margin, that are buying and holding, and the price could go down so low, they don't care. They're still going to hold and have a price target in their mind. Weak hands, while they're leveraged up, if the price action goes back down too much or for other reasons, they cash out. Once all that has happened here, this is the price to pay for all that breakdown right here. And this can be some congestion, and hopefully the price we paid right here, we won't have too much congestion, and we'll be able to go through that level of the wall here. And after that test, get close to those monthly defined resistance right here. And here's the ultimate one right here. And you know how I do this? You go through a level, now that resistance has become support, and then you bounce down, go up, bounce down, go up, etc. until they can't maintain it anymore, and then you start rolling over. So that is gold in US dollars. But where were the clues? And if you look at other currencies, and now other people have started to pick up on that, and in Australian dollars, it was just insane. Look at that, man. This has broken out. You already had a clue all the way back in December. Australian dollars had a breakout. Anybody who'd be looking at that right there could have put an awesome breakout right here. Solid close above monthly defined resistance. No overhead resistance, nothing in sight. Broke out, pulled back within 1 to 3 months. Nice pullback. Dipped a little bit below, but closed way above. And after that, next leg up. And after that, I don't know what's going to happen here. Here's my measured move, the greedy measured move. This base all the way up here to 2200, getting extended from the 12-month moving average. So what you want is pullbacks or sideways move. Let the 12-month moving average catch up. Canadian dollar, same thing. Look at that. Closed above monthly all-time monthly defined resistance. Yeah, those wicks. So we haven't beat. Oh, we barely touched. So we're hitting those all-time highs. Might need just a bit more consolidation here, but what I like is since that resistance has now become support, and after that we might get a test here, and after that go back up, but we're going upwards right now. Higher lows, we close creating higher highs right here, upwards channel out of this symmetrical triangle. And you could look across the board. The US dollar, look at that, in gold and Swiss francs closed above monthly defined breakout line. So that one here, there's a little vacuum here to get back to those highs. And even Japan, the yen has really been hit hard recently. And look at that pattern. It used to be in a symmetrical triangle, but now it's breaking out. It's looking more like a right angle triangle. And look at that right here, hitting that monthly all-time defined support resistance, and now just closing just a bit below, but we're above here, so this can consolidate in this region here and then eventually break out to the upside. So across the board again, look at that, New Zealand dollar breaking out above and then going upwards, starting to hit some monthly defined resistance right here, but already had that clue that this was going to eventually happen to the US dollar. So let's go take a look at the US dollar index. So inversely, the more the US, and they're not always in correlation. Check it out. I'll pop up the here it's one, my correlation favorites. GC gold futures. And I always ask people, you see sometimes they move, there's no correlation at all. Most of the time, but not 100% of the time. Almost a perfect correlation. You see, not even 90% negative correlation between the US dollar and gold. So for, it's not the only factor for gold going up, the price of US dollars going down, but there is some correlation, but not all the time. As you see, sometimes they move within right here, starting to etch upwards with some positive correlation, but don't always rely on those old adages. Oh, the gold has to go down when the stock market goes up, and vice versa. They could move in synergy together. Correlations change. It's good to know that they're there, but they're not always there, and the strength of the correlation can hold less and less. So the US dollar could go down and gold could go down at the same time. It's not always happening at the same time. So I just want to know the weakness of the US dollar. What has happened recently? Stage 2, here we're starting to close below that 30-week average. Stage 3, we seem to be stage 3ing top right here. And last week, not the week that closed, but the week before, we had a close below a declining 30-week moving average, and we're underperforming the SPX. We didn't manage to go back up, so we're closed below that. Eventually, maybe next month, we're going to see if we close down lower. We have a lot of support defined, Ichimoku defined support. So for the US dollar, it hasn't totally rolled over yet, but it's stage 2 uptrend has halted. You're back into a stage 3, and you're approaching a stage 4 territory. The Ichimoku defined support could help it get back up. And that's for the US dollars, guys. Let's look at gold. Now I want to check GLD. Give you a little look at that. So a lot of people, if you can't trade futures or you don't have Oanda and you're not trading those CFDs, a lot of people are trading just the ARCA, the SPDR Gold Trust tracker. And here is where I saw, okay, I'm going to remove all these drawing tools. We did close above right here. Here's a breakout, previous months. Looks pretty much like gold, like the gold futures right here, 1350, the equivalent of monthly defined resistance. Good. But right here, this previous resistance right here, the wick did manage to go straight back up. So the correlation between GLD and gold futures is not 100%. Technically, I could look at this and say this is less favorable than the breakout that we had in the gold futures we had this week. But if it follows and it tracks, maybe this is just going to be overridden by the move with the gold futures as this catches up. So the correlation is not 100%. Let me check that out. When in doubt, pop up the chart, gold futures correlation. You see, almost 100%. So there's sometimes, see, it's digging just a little lower here. Not always 100%, but very close to. How are the miners doing, guys? Monthly candle chart. Oh, scribbles. Breaking out here of this monthly defined resistance right here. A little further back, we closed above, and next step up is the next time we have resistance, guys, is all the way about to 30.50. Higher lows always. So eventually, this is confirming the gold move. We're breaking out of this monthly defined breakout lines on these two levels. Now you know that you could expect some resistance right here and maybe a pullback and then a continuation up. And then there's a vacuum all the way to these higher levels of this high mountain. But higher lows, coiling, tightening, and breaking out at the same time as we had in gold futures. So the miners are also doing good. What about the juniors? Let's take a sneak peek at that. And even the juniors, remove all those drawing tools right here. Even the miners, the juniors broke out of this 1 year, 1, 2, 3, 4, 5, 6, 7. Yeah, over a year consolidation move. And now we have an inclining 12-month moving average. And we're going to be running into some more resistance a little higher. Create bigger pattern, higher lows again, uptrend. Higher lows right here, coiling. So the juniors are probably going to be the final one in order. Spot gold leads the way. Then the big miners follow that lead. If people believe in that gold breakout, the gold miners will break out following that. And then the juniors, when everybody's happy, the late money's coming in, then people are going to start pouring in some cash in the juniors. And that's really when you get some steam ahead, that you know you're in a bull run. So right now we're embryonic, breaking out. And if you really want to wait for the juniors, you're not far off. A close above 36 on the monthly chart, and then you get a vacuum all the way up here to about the 50 level right here. everything's starting to add up, even if there's not 100% correlation with the DXY. If it's starting to have weakness, it's gonna add to you're gonna need more US dollars to buy gold. Which brings me to yields, guys. Yields. Another factor for gold is the cost of holding gold. So when you're playing CFDs or futures, I have to borrow or short US dollars to go long gold, and there's a cost to doing that, to borrow those US dollars to buy the gold, and that's the yield. And the cheaper, the less yield I have to pay, the more interesting it becomes to hold gold. And where we're going in the era of negative yields, the more negative yields we have, the cheaper it is to hold gold. And that should create an influx of money for people to start to buy gold. I think there's a chart going out with total negative yielding debt around the world. And if you overlay that with the price of spot gold, it follows it pretty much. And you have it right here. Here's the base. When these are the 2-year treasury notes. And when the price of treasury notes goes up, the yield goes down. And right here is when they're starting pricing the cycle where the Fed was starting to raise hike the rates. And after that is here's the market telling the Fed, hey, look, the yields, they're going to start going down again. So the treasury notes are increasing in price. You want this going up here. If I go and overlay or just add gold right here. And right here you had that run. So as soon as we got out, as soon as the yield started going down, gold followed suit, went up all the way up here until it started reaching low levels, and then they didn't know if they were going to go back down or not. And now sideways move, sideways move, sideways move. And right here we should be continuing up. Same thing here, and now we're breaking out. So Stan talked a lot about the weight of evidence, monthly chart patterns are breaking out, confirmations on the weekly chart with high volume for the gold. Check it out. Let's go back. Just gonna pop up the weekly. Do we have the volume? Yeah, see we have crescendo volume right here going up, increasing volume, outperforming the SPX. These are all weight of evidence, everything that's adding up. That's gonna increase the probabilities of having that possible continuation move upwards for gold. Hey, what happened? What happened? Okay, right here, GC. Let's pop that back up, just for a little final checkup on that. And right here, go up, sideways move, and then go up once again. More negative yielding debt, the cheaper it is to hold gold, and the more people are going to start wanting to hold gold instead of holding dollars where you have to pay. So they're all devaluing their currencies. The US dollar is just the strongest of the bunch, maybe with the Swiss franc, but they're all breaking down right now, trying to devalue their money for whatever reason. But they're doing it by reducing interest rates. They're devaluing. Why should I hold that currency if I'm only getting 1% or 0% on it when I could be holding a currency that's giving me more interest? But now the tendency is they're all going down to zero rates and eventually negative rates, guys. And that is pretty it for gold, guys. Everything's synergizing together. There's one little thing I'd like to talk about is the gold to silver ratio. Let me pop that up right here. Gold to silver ratio. All right. Gold to silver ratio, I see that as the fuel for the next rally. Let's do it this way. GC. GC. GC divided by silver futures. So here is my what? Why won't it let me do it? All right. Okay, let's do it the old-fashioned way, because I had more data. If I divided the gold futures, Wanda, I don't go that far back. But this is right here, XAU, XAG. This is the fuel for the next move up. I'm going to add just another chart. Add symbol. Silver futures. When the gold ratio is getting super duper high, when it starts deflating, that means the price of silver is starting to outperform the price of gold. They could both be still increasing in price. It's just that silver will start increasing in price faster than gold. And when you have, like we had the order, gold spots, the first one to go up, then the gold miners, then the gold junior miners. And after that, then you have money pouring in when people think either that's too expensive, and then you have silver coming in. So when gold's already in a run, the first one to go up, then after that you have silver that starts going up, but even faster than gold, and bringing down the gold silver ratio. And that's what I call the fuel. So now you're just loading up. Everybody, if they're going to play something, they're going to play gold. They want to make sure that gold breaks out before playing silver, which is less of a safe haven, but more of a used in the industry, etc. So they're letting gold inflate more than silver. And when this starts really to start going down and silver starts really picking up, that's going to be bullish for silver, and it's going to be bullish for gold, because gold has already had and tamed its stage 2 up run, and silver will just be pushing it back all the way down. And then you got to start to think about getting out when the inverse happens, is when silver starts underperforming gold. And after that, when that pattern breaks up to the upwards, you could be going down for deflation in those precious metals, as silver, people are starting to get out of silver, and the gold is going to take a little vacuum, bring the price action back down. So use the gold silver ratio to know when to go long silver. I like silver. I started seeing some cool stuff with silver in New Zealand dollars. Just like I used the price action of other currencies for gold to see what might be happened for gold in US dollars. Use the other currencies as little leading indicators to know what's going to happen. Right now, still in a downtrend, but when we see that silver is gonna, where is it? XAU, XAG, AUD. Well, you see it's starting to flatten out. Higher lows on the monthly chart. When we start closing above important monthly defined resistance, and then those currencies one by one, they're going to start breaking up, holding that resistance. Now going to be support, and we'll be holding it. Eventually we'll get to XAG USD, silver expressed in US dollars, and it will have a breakout just like gold did. And then the ratio of gold silver ratio is going to start going down, and we'll be in a bona fide bull market. Woo! All right, guys, it's a long one, but I think that might be the future for bad charts for my podcast. Try to cover a whole sector, a whole field of meaningful information to increase probabilities of having a successful trade. And look, if ever the metrics start breaking down in the inverse and it doesn't pan out, then we adjust. But right now we're looking at the data, we're looking at the charts, and it's telling me that it's a go for gold. All right. Thanks for watching, guys. See ya.